Hello traders, you are welcome to this video and you are welcome back to the Forex Geek channel. In this video, we are going to be looking at a powerful tool in Forex trading and specifically we are going to be looking at cycle indicators. Okay, so these indicators are essential for anyone who wants to understand market timing, spotting trend reversals, and making smarter entry and exit decisions. All right. So if you are ready to take your trading knowledge to the next level, make sure you hit that like button and don't forget to subscribe for more in-depth trading tips and strategies. So without further ado, let's get started. First, let's talk about what cycle indicators are. Cycle indicators help us analyze periodic behavior in the market, capturing the natural highs and lows that happen over time. Now, unlike standard trend indicators, which just show us the general direction of price movement, unlike such indicators, um, the cycle indicators give us insights into the timing of those price movements. Okay, so basically this is like the difference. Okay, you can think of it like a wave. Markets go up, right? Markets go up, they go down. Markets do not, the price of an asset do not move in a straight line. Okay, basically in the financial markets, price does not move in a straight line, right? So you can think of it like a wave. Markets go up, they go down, and they do so in cycles, right? A cycle indicator helps us identify the points when that wave might be cresting or throwing, letting us know when a trend could be about to shift. Okay, now this knowledge can be incredibly helpful for timing our trades, giving us a potential edge when deciding when to buy or sell. Okay, now why should you care about cycle indicators, specifically in Forex trading? The Forex market is known for its volatility. Okay, if you are new to the Forex market, then you should be aware, or it's important that you be aware that it's a volatile market. Okay, and of course, if you have been in the game for long, you would already know that the Forex market is a volatile market, right? It's fast moving with trends and reversals happening constantly. Now, cycle indicators can help us cut through some of this noise, pinpointing patterns that might not be obvious at first glance. When you are trading, you are often dealing with multiple factors, including economic news, global events, and overall market sentiment. Amid all these, cycle indicators act as a sort of filter, helping you tune into recurring patterns and avoid getting caught up in the chaos. All right. Now, essentially, they can help you identify where we are in the price cycle and plan your trades with better timing. So let's get into some of the most commonly used cycle indicators in Forex. Okay. Now, one of the indicators that many traders use is the moving averages. You might be familiar with these already. But when used to track cycles, now we are talking about specifically using these indicators to track cycles, okay? When used to track cycles, moving averages, especially smoothed or weighted ones. So now I'm going to be adding the moving average to the chart, but we are not going to use neither EMA nor SMA. We are not going to be using simple moving average. We are not going to be using exponential moving average. In this case, because we are using it as a cycle indicator, we are going to use the smooth moving average. Okay, you can also decide to use the linear weighted, because when it comes to cycle indicator, it's especially smooth or weighted moving averages that are being used. Okay, because they can show us when price momentum is picking up or slowing down. All right, so and it often aligns with the market cyclical behavior. Okay, So when you are using the indicator, basically the signals are not exactly, or would I say entirely, new to what you already know about the moving averages. As you can see, the pattern is still somewhat the same in terms of price crossing over the moving averages upwards being a buy and crossing downwards being a sell. Okay, it's just that the parameters for calculating the averages are not exactly the same. That is for the smooth moving average and for the simple moving average and for the exponential moving average. Okay, so when you want to use the MA as a cycle indicator, then you should use the smooth or the weighted moving average. Okay, because of how it aligns with market cyclical behavior. Let us go to a higher time frame and also just take a little look at it. All right, now you can see there is no much difference with what you already know with the moving average. All right, now in terms of the second indicator on our list, we are going to be looking at the stochastic oscillator. Now this indicator compares a currency pair's closing price to its price range over a specific time period. What makes the stochastic oscillator useful for cycle analysis is that it can show us when a currency pair is overbought or oversold, which can often signal the start of a cycle reversal. So one of the reasons why stochastic oscillator is among the cycle indicators is due to its overbought and oversold feature. Because when the stochastic oscillator is telling you that this particular asset is overbought, it can show that the next sell wave is coming. Okay, so now you can use the stochastic oscillator to ride cycles. Basically, when considering riding cycles, then we are dealing with the higher time frames. Okay, we are going to be dealing with the higher time frames. So if you want to use these indicators as cycle indicators, and I will recommend that you work with higher time frames, perhaps daily, weekly, monthly. Okay, because we are talking about cycles. So when an asset is in a bearish trend on a high time frame, you will know that you will ride that bearish trend till the end. Okay, and when it is in a bullish trend, you would know that you will be intending to ride that bullish wave till the very end. Okay, so this is not for scalpers. All right, it is mostly for swing traders and position traders. All right, now the next indicator on our list is the relative strength index. Okay, now just like the stochastic oscillator, the RSI measures momentum. With RSI, a value over 70 typically indicates that an asset is overbought, while a value below 30 means it's oversold. These thresholds can help you pinpoint where we might be in a price cycle, allowing you to anticipate changes in the trend. Okay, so just like how the stochastic tells you when an asset is overbought and when it's oversold, and when a bullish cycle is perhaps coming to an end, the RSI also does similar. Okay, and then finally, the cycle period analysis tools. Now there are some platforms that also offer cycle specific tools. Okay, tools that are specific to cycles. All right, and such tools track things like periodic highs and lows. Okay, now such tools help detect dominant cycles in a currency's price action, and gives you more precise timing insights. Okay, so these indicators, when used together, can give you a powerful toolkit for reading the rhythm of the Forex market. Okay, so how do you actually use these indicators in your trading? Let's just break it down in a few key steps, right? So you have to, first of all, choose your indicators carefully. Start by picking one or two cycle indicators that you are comfortable with. Using too many can lead to analysis paralysis. So focus on a couple that work well together. For example, you can pair the RSI with the moving average, okay, and it can give you a great sense of timing and momentum. Now, secondly, analyze market trends and cycles together. Cycle indicators work best when combined with other forms of analysis. So it's important that you start by looking at the broader trend, okay? Is the currency pair in a long-term uptrend or in a downtrend or moving sideways? It's important that you consider that. Once you understand the trend, use cycle indicators to find the best entry or exit points within that trend, okay? Now, thirdly, set realistic expectations. Remember that no indicator can perfectly predict the market, all right? Cycle indicators are tools that give you a probability-based edge, but they are not guarantees, okay? So always keep your risk management practices in place, whether that's setting stop loss levels or adjusting position sizes according to the cycle signals you're seeing, all right? Now, fourthly, test and refine your approach. Like any trading strategy, using cycle indicators requires some trial and error, okay? So, it's normal to have trial and error. Now, so it's important that you practice with a demo account first, test different indicator settings, and see what works best for you, okay? Over time, you'll find a rhythm that fits your trading style, all right? Now, let's quickly go over some common mistakes traders make when using cycle indicators. The first is relying too heavily on indicators alone. Cycle indicators are useful, but they are not the whole picture. Okay, it's important that you note that. Make sure to combine them with a strong understanding of fundamentals and market sentiment. Secondly, forgetting about time frames. Cycle indicators can behave very differently depending on the time frame you are trading in. A cycle that looks perfect on a daily chart might not make sense on a 5-minute chart. Like I already said, I will recommend that when you are trying to use these indicators as cycle indicators, or basically when you're trying to track cycles, focus on higher time frames. I don't think as a scalper, you should be, trying to track cycles or something like that, unless if maybe you just want to scalp in the direction of the trend or in line with the cycle or the ongoing cycle, okay, then that's fine. But basically, I would recommend that you use cycle indicators specifically for tracking cycles or specifically for trading cycles on the higher time frames. Okay, so always adjust your cycle indicators based on the time frame that matches your trading style, but I will recommend using it on higher time frames. Okay, but if you still want to, work with these smaller time frames, then that's fine. Yeah, but in that case, you might not exactly be tracking cycles anymore. All right. Now, thirdly, overreacting to every signal. Not every cycle indicator signal requires action. Remember that these tools are giving you information about probabilities, okay? So stay patient and avoid making quick decisions based on short-term cycle fluctuations. So there you have it, a complete guide to understanding and using cycle indicators in Forex trading. With these tools, you can get a better sense of market timing, helping you make more informed entry and exit decisions. Remember, the goal here is to gain an edge and read the market's natural rhythms, not to make predictions, okay? Now, if you found this video helpful, make sure to hit that like button and subscribe to the channel for more Forex insights and strategies. Drop a comment below if you have questions or want to share your own experiences with cycle indicators. Thanks for watching and happy trading.